Petroleum Nasional expects lower profit for its FY2023 compared to the record high earnings it saw in FY2022, as net profit for its third quarter fell by 22% year-on-year to 23.9 billion, mainly due to lower average realised prices in tandem with the declining benchmark oil prices. Revenue declined by 16% to 82.9 billion from the 98.9 billion that was posted a year ago. The national oil company recorded its highest annual net profit of 101.62 billion in FY 2022, more than double the 50.87 billion it earned in FY 2021 as it benefited from elevated oil prices. Petronas expects the volatility in oil and gas prices to continue to be elevated by persistent economic uncertainties and heightened concerns over global energy security amid geopolitical tensions in the Middle East, which colours its anticipation of lower profits for the current financial year. President and Group CEO Tan Sri Tunku Muhammad Taufik says that Petronas' performance in the third quarter demonstrates the focused delivery of its energy transition strategy despite a volatile energy market. Muhammad Taufik says that Petronas is on track to achieve full utilisation of the 20% capital expenditure committed to intensify decarbonisation of the group's operations and growth in new business. Petronas also remains resolute to navigate the cyclical swings in the energy market with a firm commitment to not disrupt and make every effort to provide energy that is safe, responsibly produced, co-optimized and emissions abated. Malaysia Marine and Heavy Engineering Holdings has secured a subcontract for an offshore substation high-voltage direct current platform from Petrofac International UAE worth 1.2 billion ringgit. The scope of the subcontract, which was awarded to MHB's wholly owned subsidiary Malaysia Marine and Heavy Engineering, consists of construction engineering, fabrication, mechanical completion, loadout and sea fastening, and architectural works on a engineering, procurement and construction basis. The subcontract is for approximately 54 months, with fabrication to begin in 2025 and to be completed in 2028. MHB added that in addition, MMHE and Petrofac will collaborate towards the possibility of fabrication works for 2 additional units of OSS of similar size. Petrofac's delivery of the OSS is for Netherlands' National Electricity Transmission System Operator 10T's 2GW program. The 2GW program is an energy transition program to make Europe the first climate-neutral continent by 2050. MHB Managing Director and CEO Pandai Othman says that the project represents a significant achievement for MHB on 2 fronts that it has been diligently pursuing, venturing into renewable energy and establishing its presence internationally. He adds that MHB will be expanding further the reactivation of MMHE East Yard, which will be utilised alongside MMHE West Yard in delivering this project. Public Bank's third quarter net profit rose by 7% year-on-year to 1.7 billion on the back of healthy loans and customer deposits growth. Revenue for the quarter ended 18% up year-on-year from 5.5 billion to 6.48 billion ringgit. No dividend was declared for the quarter. Public Bank said that for the quarter under review, net interest and Islamic banking income increased by 90.2 million, while non-interest and financing income improved by 16.6 million ringgit. The bank said these were partially offset by higher other operating expenses and higher loan impairment allowance. MD and CEO Tan Sri Dr. Teh Alex said that the group continued to demonstrate resilience in its financial performance, with its loans and deposits businesses sustaining a positive growth trajectory and achieving a commendable net ROE of 13.1%. On its prospects, Public Bank said it remains committed to strengthening its regional presence in Indochina while leveraging its strong branding and prudent management practices. In particular, the bank says it continues to expand its business in Vietnam, capitalizing on the robust economic environment. Tay adds that as the Malaysian economy remains on a positive growth path, there is continued financing demand for property and car ownership, as well as from SME businesses. The bank also continues to see emerging opportunities from the development in the ESG landscape and digital transformation. Tay says the group's agility, supported by its healthy capital and liquidity position, coupled with its resilient asset quality and prudent loan loss reserves, will enable Public Bank to generate sustainable profit through challenging times. Axiata Group saw its net loss widen to 797.4 million for its third quarter from 52.4 million a year ago, mainly due to asset impairment and lower share of results from subsidiary Celcom Digi. The impairment of 1.01 billion during the quarter followed the reclassification of its Nepal unit Ncell as an asset held for sale, resulting in a widened discontinuing operations loss of 824.5 million ringgit. Net profit from continuing operations stood at 27.09 million against a net loss of 412.1 million a year ago, driven by lower foreign exchange losses mainly from US dollar denominated borrowings and working capital, lower finance costs and higher share of profits from associates. Quarterly revenue, however, improved to 5.7 billion from 5.37 billion ringgit. Chairman Tan Sri Syahrir Ridwan said that Axiata continues on its value creation journey despite the significant macroeconomic challenges. He said it remains focused on adapting its strategy, refining its investment portfolio and cultivating the right partnerships to position the group for long-term success. Group CEO and MD Vivek Sood says that Axiata remains on track towards meeting its 2023 headline KPIs and that its assets will continue to grow as market structure improves, price stability prevails and demand for mobile, digital and enterprise solutions remain. Meanwhile, Bloomberg reported, quoting sources, that NTT Docomo has joined a consortium led by Mitsui & Co. in the bidding for a majority stake in Axiata's tower unit, edotco Group. The consortium, which also includes J Tower, is offering to buy new shares in edotco for about $750 million. Bloomberg also reported that the Mitsui-led consortium is also interested in buying existing shares owned by Innovation Network Corp, Khazanah Nasional and Kumpulan Wang Persaraan Diperbadankan or KWAP. A potential purchase by the Japanese consortium could be worth about $1.5 billion and would give the group a controlling stake in edotco of more than 50%, according to people familiar with the matter. FGV Holdings saw a more than sevenfold decrease in net profit for its third quarter to 31.98 million from 241.7 million a year ago, owing to a significant fall in profit contribution from its plantation segment. Revenue fell 21% year-on-year to 4.91 billion on the back of lower crude palm oil realized prices. No dividends were declared for the quarter. According to FGV, the sector's results were further brought down by the lower margin achieved in the downstream business and share of loss results in JVs of 9.55 million compared to a share of profit of 10.77 million in the previous year's quarter. FGV was more bullish about the quarter ahead as it projected CPO prices of between 3,800 per metric ton to 4,000 per metric ton. The planter said this is supported by the anticipated impact of El Nino, heightened demand in India driven by Diwali restocking activities and the expanding palm biodiesel industry, all contributing to a bolstered price environment. FGV added that although production costs are expected to remain elevated, a potential moderation is foreseen due to lower fertilizer and energy consumption prices. Barring any unforeseen circumstances, FGV said it anticipates to achieve a satisfactory financial performance.